This is Corey with Sims Investment Management. This is another monthly market update. This is our second month coming from you from our new home at 3322 Erie Avenue. We're about 90% or so settled in, still a few finishing touches, but so far the staff's really enjoying the new office, and I think clients are going to like it too. Speaking of that, we are having this Saturday, July 27th from 10 to 1 outside. We're going to be supporting a really great cause called Peyton's Lemonade Stand. We talked about this last newsletter, but this is a charity that I recently found out and the team has rallied behind, of kids serving kids. And so there's lemonade stands all around the city on Saturday, and all the proceeds will then go to supporting Children's Hospital and some other kids charities here in Cincinnati. So if you're around the area, please come by, buy a glass of overpriced lemonade, and come check out our new office, as we'll have the doors open for people to roam around. In regards to business this month, we've got our annual mid-year annual letter that we send out to clients. So we typically send this out in January and July. We do a quick recap of just our general guiding principles, which I think is really important. It's a good dose of vitamin C for clients to hear a couple times a year. Things like we're not market timers. We believe in focusing on your financial plan. Turn off the news and not believe everything that you hear online or on TV. But then there's also some observations of just what's transpired the past 6 months, and touching on kind of the state of the consumer right now. Obviously, there's been some exciting shakeup the past 7 to 10 days with some of the political election ramifications. So we're getting some questions on that, but really what I want us to focus on today is the fact that the consumer and the businesses are really, really strong. One could argue that the consumer and businesses have never had as healthy a balance sheets as they have currently. So yes, the federal deficit has continued to increase, and the debt that we owe as a country has continued to increase. But the good news is a lot of that debt that the government has issued is actually fallen into the pockets of consumers and businesses here in the United States. So just some really fascinating facts. Let's see, some estimates are that since prior to 2019, prior to COVID, we've had roughly a 37% increase from 117 trillion to 160 trillion in U.S. household net worth. What's pretty fascinating about that is U.S. GDP is around $30 trillion. So right now we're estimating that U.S. household net worth is about 5 years worth of U.S. GDP, which is a really great level to be at. Another kind of just general observation is the S&P 500. If you bought the entire S&P 500, it would be worth $50 trillion. So we're saying the U.S. consumer has in net worth about 3 times the value of the S&P 500. So a lot of that's tied up in obviously equity in someone's home, and that talked about how the fact that since 2019 we've added roughly $12 trillion in home equity. So as prices have certainly risen on houses over the past few years, there's been many consumers and many Americans that have benefited from that. So we estimate now that we have about $22 trillion in net worth in our homes here in America. And then if you go over to just cash, we're thinking estimates are somewhere between 10 and 13 trillion dollars between money market funds, CDs, and cash and checking accounts, which is up significantly from the 2019 levels. And last but not least, corporations are sitting on about $4.4 trillion worth of cash as well. So this is also right near record high levels. So the consumer's pretty strong and healthy on a balance sheet overall, and so are our businesses. Last thing that I kind of want to touch on is this concept of rebalancing. We have been asked a lot recently just about, why don't we buy more NVIDIA, or why don't we buy this AI stock or this semiconductor stock? And I think the biggest thing that clients need to remember is human nature is very inclined to go reinvest and buy more of the thing that's going up the most recently, and wanting to sell out of the things that have not done as well recently. And that's actually the opposite of what we should be focused on, right? Because if you think about price and value, they're inversely correlated. So in most things in life, if the price is going down on something, we perceive that the value of that is going up, right? If the price of a car goes down, we think we're getting a good value. If the price of a house goes down, we think we're getting a good value. But yet, for some reason in the stock market, where we're buying good, sound, fundamental companies, people seem to forget this, and they forget that when the price of stocks are going down, there is a potential that the value has drastically gone up, and maybe we should be looking at the things that have gone down in value, not chase after the things and double or triple down on the things that have ran recently. So that's why we focused on rebalancing and keeping that in mind when we're looking at client portfolios. The other thing that I want to touch on briefly is just setting client expectations on how long it takes for their money to double. So if you think about, historically speaking, the market doubles every 7 or 8 years on average. And so sometimes we get clients that might get frustrated where they've owned something for 1 to 2 years and they're wondering why it hasn't performed well. And I just want to reset expectations that when we're buying things that the prices come down because we think there's good value, it's not because we think we're going to flip that in 12 to 24 months. It's because over the next 5, 7 to 10 years, we think that investment is going to do better than what the overall market has done. So, something that's maybe we've owned for 2 to 3 years that hasn't quite recovered as much as we thought it would or hope it would, doesn't mean that now it's a terrible investment. It just means that we're pretty short still in the timeline that we anticipated on owning it. That's it for this month. I know this is a little bit long, so I'm sorry about that, but hopefully these are important concepts. You can check out some of the resources that we have for this month below, and hope to see some of you guys on Saturday. Thanks.